Good morning and welcome to Money Control. Well, the market is only trading flat this morning, but we continue with our conversation on how to navigate this bull run in the short, medium and long run. And I have with me a market veteran, a veteran fund manager turned CIO turned CEO, Nilesh Shah from Kotak AMC. Nilesh, thank you so much for joining me this morning.
Thank you, Mahalakshmi, for having me over here.
Sure. So straight to the point, Nilesh, you've seen so many market cycles. How is this time different? How does it feel different?
There is no difference this time. Markets are driven by three things: funds, sentiments, and fundamentals. Today, like before, there is a Triveni Sangam of flows, sentiments, and fundamentals. From foreign portfolio investors to domestic investors, there are more aggressive buyers than sellers in the market, and which is why prices are rising. These people are buying because they are positive on India. In some sense, India growth story was well known, but something like Birbal ki kahani has happened with India. When Akbar told Birbal to make a line bigger without touching it, he drew a small line below and the line above became bigger. Same thing is happening with India. Our growth story was bright, but other story has become much, much darker, and hence our story looks even brighter. Look at our competition from Russia to China to South Africa to Turkey. There are lesser and lesser investment options for global investors. So sentiments are turning positive for India. And finally, flows and sentiments have no meaning if fundamentals are not there. Fortunately for us, fundamentals have improved over the years. And this Triveni Sangam of flows, sentiment, and fundamentals have come together. Like in the past, if we don't deliver, this momentum can't continue. But there is hope this time that we will deliver.
Sure, Nilesh. I mean, if you were to just break this down into short, medium and long term, how does the risk reward really look? Because obviously for this year, from this year's perspective, we look very tall in terms of growth. So how do you look at it time period wise if you were to analyze the same scenario? How do we stack up?
So in the short term, I think there will be very, very high volatility. We have events from Fed pivot to election coming, and some of those events could surprise the market. Market has discounted most of those events to be positive, and any surprise over there could immediately cause a correction. While there is uncertainty in the short term, the confidence on the long term is immense. As per IMF and various other agencies, India will become third largest economy in the next couple of years. This growth is driven by as much as government intervention as private sector. Corporate India is becoming global. Growth is visible. So on the long term, I think there is consensus that Indian equity market, Indian assets are something to be worth investing. Between these two extremes, short-term uncertain, long-term fairly certain, medium-term will probably swing between fear as well as hope. My bet will be short-term, keep some dry powder for correction, medium to long-term, stay invested for a participation in India growth story.
Sure. So, and over the next 1 year, Nilesh, how do you see growth itself panning out? Of course, you alluded to, election being a risk. We'll come to that. But first of all, looking at the, results that have been declared so far and the overall environment also, how do you see growth panning out over the next 3 quarters? Because last year, most economists and analysts underestimated growth and there was a positive surprise. This year also, we got into the year thinking that, there will be a recession in the US. And only in the last FOMC meeting, the Fed chair said that, the Fed is no longer expecting or forecasting a recession for this year. Do you expect any positive surprises on growth by the end of this year?
So if we look at street estimate of growth, that was kind of below 6% for FY24. And the RBI's estimate was kind of 6.5%. I feel street will veer to RBI's estimate over next 3 quarters, and we may end up a growth rate kind of between above 6% for FY24. But this game is not just for FY24 growth. This game is for a sustenance of growth above 6% for probably decades to come together. And one big factor for this growth to sustain is infrastructure creation. Throughout our past, we always heard that India's infrastructure is lacking and hence our growth is constrained. What we built from 1947 to 2013, over 67 long years, similar infrastructure is being built between 2014 and 2024. Highways, both state and central put together, will jump from 82,000 kilometers to 165,000 kilometers. Port capacity is doubling from 1,400 million metric tons to 2,800 million metric tons. Power capacity is jumping from roughly about 235 gigawatt to 435 gigawatt. Metro from 5 cities is growing to 27 cities. If we look at all the data across road, port, power, railway, telecom, there is as much infrastructure creation between 14 to 24 as was created between 47 to 2030. This creation of infrastructure gives us confidence that we can sustain this growth rate for a longer period of time.
Sure. And Nilesh, how do you see this infrastructure opportunity really play out in the stock market? Because if 2003 to 8 boom is anything to go by, that's a period where, the infrastructure story got built in terms of expectations in the stock markets, but most of the companies failed to deliver on, a return to shareholders. This time, do you see it pan out differently, and what is the difference that you will count on?
Very, very important point, Mahalakshmi. And, there is a Hindi proverb, "Ka jala chhas bhi phuk phuk ke peeta hai." If you have been burned by drinking hot milk, even a cold lassi, you will be cautious while drinking. We fund managers fall into that category. We have seen in 2008 cycle how leverage destroyed good companies in infrastructure sector, how corporate governance destroyed infrastructure companies in that cycle. This deadly combination of leverage and corporate misgovernance is something which we have to avoid. And today also, if we look at our universe of infrastructure investment, clearly we have been far more focused on companies which are not leveraged, companies which have appropriate governance. Now, this does narrow down our choices, but it is far better to lose in the short-term momentum, but win over a longer period of time. So the scars of 2008 are still in our memory, and hopefully it will keep the guardrail on our infrastructure sector investments.
Sure. And how do you see the interest rate cycle panning out, Nilesh? Do you think we have seen the peak? And what is your expectation in the coming MPC meeting?
So clearly, RBI has been far ahead of the curve compared to other central bankers. They brought down liquidity from close to 9 lakh crore to as low as 1 lakh crore. And now liquidity has gone back thanks to 2,000 rupee note coming back to almost 3.5 lakh crore. They also raised interest rates operatively from 3.35 to 6.5%, while officially it moved from 4 to 6.5 operatively it moved from 335 to 6.5. This combination of drainage of liquidity and raising of interest rates has given RBI real positive impulses. In this MPC, I believe they'll wait and watch. Their commentary will be reassuring to market that we will be data dependent. And while there is likely to be a spike in inflation for next 2 months, that's driven by monsoon and natural vagaries rather than any fundamental demand supply equation. Probably RBI will reassure markets that we'll see through this inflation number, but we'll keep a hawkish watch on inflation and we will be data dependent. I think RBI has reached peak of raising interest rates in this cycle, but the rate cut cycle will begin only after US Fed starts cutting interest rates.
So would you think that is at least 3 quarters away or more than that?
Undoubtedly, it looks like as of today, 3 quarters away. US market was expecting Fed to cut rates by mid 2023.
Right.
Now it has moved to mid 2024. There's no point in running ahead of Fed, even though we have now reasonable cushion in terms of our own de-risking.
Sure. And Nilesh, how is this current prevailing interest rates really impacting allocations for global for local investors? Is this rate really, are savvy investors trying to switch a bit to fixed income? Is that becoming an allure?
Mahalakshmi, I lost you in between.
No, I was asking, how is this prevailing interest rate really playing out in terms of local investors' allocations? Are people tending to put in more money towards fixed income? Are they pulling out of equities, putting in fixed income, especially the savvy high net worth individuals? Because 8.5% is a fairly good rate, so to speak, and given the current valuations, and if you just see moderation over next 1 or 2 years, is that becoming a point to reallocate for a bunch of investors?
So Mahalakshmi, there is no heterogeneous India, there is no homogeneous India in this. There's a lot of heterogeneousness. There is one set of customers which is realizing that their asset allocation is too heavy towards fixed income. And while fixed income at this point of time is attractive, it hasn't worked out well in the past compared to, let's say, equity or real estate. Those guys are shifting their allocation from debt to equity. There is another set of young India which is investing in SIP, in equity mutual funds for a longer term. They are predominantly large equity and less fixed income orientation. Then there are HNIs. Many of them have earned a lot of money and they just want to protect their capital. They are grabbing duration at this point of time by locking themselves into longer maturity paper. So there is no one standard definition for investors. There is a different mix of investors, from young India willing to take risks to HNI India, which is trying to protect their capital. And they are all choosing their investment vehicles very, very smartly. One point I would like to highlight is the tremendous maturity of retail investors. In the past, whenever market used to correct, the flows used to slow down. Now it is exactly opposite. In a rising market, it is SIP minus redemption and net flows come down. In a falling market, it is SIP plus subscription and we get more money to buy into a falling market. I think this maturity of investors is truly protecting the bottom of the market.
Sure, Nilesh. Now, just coming back to a point that you talked about elections, when do you see this election becoming part of the market narrative? Because ahead of elections, obviously, there is a lot of speculation and that starts to make the markets nervous. Would you expect something like that? And when do you think that conversation will begin to become part of the market narrative?
So we have seen that market is not necessarily the best predictor of election outcome.
Right.
analysts and surveys going wrong on election, market also misses jungle for the wood. In 2004 as well as 2009, we have seen market completely missing the election outcome. At this point of time, market is discounting the continuity of government policies and continuity of government. They'll continue to observe data on the field. If there is any deviation to what is discounted by the market, then there could be correction. But it will be fair to say that market has a keen watch on election outcome. And at this point of time, market is discounting there will be continuity of government and government policies.
Sure. And in terms of macro and global risks, Nilesh, is there anything particularly that stands out for you in terms of risk?
Undoubtedly, we are part of the global economy. In a slowing global economy, it will be difficult for us to accelerate. So we'll have to keep a watch over how global economy evolves. Undoubtedly, CY23 is likely to be subdued compared to CY22. Second, for us, IT sector continues to be major revenue earner. And today there are some dark clouds on IT sector in terms of growth. Energy prices is important for us, not only from price point of view, but also availability point of view. The geopolitical scenario, which is changing so rapidly, we'll have to ensure that energy is available to us at cheaper prices and it is available as much as we want. Finally, there is Fed pivot. If you are going to get, higher interest rates in US dollar treasury, to that extent, your expectation of return from emerging market equity, including India, will be higher. And that could result into de-rating of our valuation as we trade at premium to others. So there will be many global factors which will continue to impact market, and which is why our first advice, please keep some dry powder at this valuation of the market. It's a fair value market or little above fair value, and hence having neutral allocation to equity with some cash to buy during correction will be appropriate.
Sure. Again, with respect to equities, now in the last, at least this year, there has been a resurgence of sorts in real estate also. Do you see that as becoming a competing asset class over the next few years?
So, Mahalakshmi, there are sets of people who are going into real estate because outside of metro areas, it still has ability to absorb your black income. This is one of the reasons why real estate continues to remain a preferred investment for many, many investors. But if you look at an average experience of an investor in real estate vis-a-vis, let's say, equity market, undoubtedly equity far outweighs the real estate. Returns are better, convenience is far better, ease of entry and exit is much, much better. So put together, my feeling is that while there will be a set of investors which will go to real estate, on an incremental basis, mutual funds and equities will continue to do better than real estate.
Sure. Nilesh, you said the market seemed to be fairly valued. So if you look at across the board, large, mid and small cap, there has obviously been a lot more I won't say exuberance, but a lot more bullishness around small caps. Would you read that as exuberance, or is it just a catch-up rally?
No, Mahalakshmi, I will say that there is pocket of euphoria, exuberance, and irrational exuberance. We have seen in 2000 how companies changed their name to technology and stock rocketed. Same thing is today happening when companies are moving into artificial intelligence, where any intelligent person should not believe in such kind of artificial intelligence. There are pockets of irrational exuberance in micro caps, mini caps, small caps. There are many companies which are trading way above their fundamental valuation simply because float is controlled by certain interested parties. This kind of stock should be avoided at all point of time, especially at this point of time. This pocket is irrational, undoubtedly.
Sure. And within the milieu of various sectoral funds, thematic funds, etc., Nilesh, what would you suggest is a relatively undervalued or underappreciated portfolio right now?
So as of today, there are two sectors which are little bit below its fair value, and I wouldn't call it significant discount, but undoubtedly little bit below. One is pharma, other is IT. In IT, as I mentioned before, there are uncertainties in the short term about demand growth. We believe the second half IT spending will be stronger than first half, and hence to some extent this will be mitigated. The bigger worry is related to machine learning and artificial intelligence. Will there be elimination of basic programmer because of advancement in artificial intelligence? We believe companies which will ride the curve of artificial intelligence will become more efficient, will deliver better solutions, and hence investing with them over a medium term will be profitable. So IT is one sector where one can start making investments. It's going to be uncertain for a while, but then you have to catch the falling knife. When certainty is there, prices would have moved up. The same thing is with pharma. Valuations have corrected. Uh, the catalyst for pharma sector will be related to generic product approvals and expansion in margin over a period of time. Unlike IT, where broadly industry moves in similar direction, in pharma, companies can have completely individual behavior. So build a portfolio of pharma and IT stocks over a period of time. They look undervalued relative to their historical valuation in relationship with the market today.
Sure. Nilesh, this pharma is one sector that, we've talked about a very strong growth story for many years now. And for a multitude of reasons, whether it is generic pricing or, consolidation and US vendors or whatever, that pack has really not performed. Do you see that changing, and what could trigger that change?
So undoubtedly market expectations are lower, and any catalyst on those expectations will result into re-rating of the sector. One important thing is that today 45% of medicines consumed by Americans by volume is made in India, and yet it costs just 10% of American pocket. Clearly, we are the cheapest medicine provider to American ecosystem. At some point of time, there will be equilibrium between distributor and manufacturer of medicine. Today, there is oligopoly in US distribution system. And unless until margins move from distribution to manufacturers to some extent, this scenario is unlikely to continue. We have already seen some Indian companies not launching a product if the margin is not sufficient. My feeling is that one, there will be equilibrium between distributor and manufacturer from a margin point of view in the days to come. The second will be again adoption of Indian medicines across the world. There are many companies which are now moving into branded launch. This also will aid to the margin. The third and the final thing is India story per se. As we move from $2,500 to $2,000 per capita GDP, from spending on roti, kapda, makan, will be now focusing more on education, entertainment, travel, tourism, and medicine. Put together all these things together, I think there is bright days ahead for Indian pharma sector.
Sure, Nilesh. One more pocket I wanted you to comment on. What is your house view on, some of these sectors like defense, electronic design and manufacturing? Again, their prices in those stocks seem to have run up quite sharply. Would you think it's a good idea to sort of play out, they will play out over the long run, and expectations will be met? Or is it time to sort of, sober down a bit and go down on weights on these stocks?
So one, this sector will be most vulnerable to any change in the government. The current priority towards domestic manufacturers of defense equipment has resulted into this bull run. Now, if there is any change over there, then certainly this sector will become more vulnerable. We believe over here a lot of expectations have been built and some amount of profit booking is warranted. The long-term fundamentals of this sector continue to look good if domestic manufacturers get priority. Over a period of time, we believe there will be companies which will not only supply in local market, but also offshore market. But please remember, it's very rare that a country will buy defense goods from our side unless until we are supplying in local market.
Sure. And do you have the same view on electronic manufacturing design, some of these new age companies that have come in? And also the tech plays, the new age tech plays. What's your take on both these quarters?
So again, in this sectors, our experience is limited. We ourselves are trying to understand nuances of this sector, and hence we are very cautious. We are probably fishing in a shallow water before taking a plunge in the deep water. My recommendation is that go into this sector on a diversified basis. You never know which company will deliver and what are the circumstances in which they'll deliver. We would love to gain some experience of this sector before taking a bigger call.
Sure. So this is my last question, Nilesh. What's your call on your own business, the AMC business? Are stocks there fairly valued, overvalued?
Fortunately, I'm not a listed company, so I don't
Yes.
have to worry about day-to-day price movement. But Mahalakshmi, let me answer this in a philosophical way. There are very few businesses in the world where not only you make money, the profits, but also you get blessings from your investors. A mutual fund is one industry जहाँ पे दुआ और पैसा दोनों मिलता है. Such industry is unlikely to disappoint their investors. When I look at my competitors, there are many competitors for financial savings, but are they indeed serving the customer? Many are serving on transaction side, many are serving on protection side, many are serving on something else. But we, the mutual fund industry, is serving people on making them rich. And this is what is going to give blessings from people. Profit plus blessings together, AMC stock should do well.
No, but what does it mean for the stocks and the business? Because the environment in which we are operating obviously is pushing cost expenses down. Is that factored into the market?
I think market is smart enough to factor in all the regulatory changes which are coming. And I still believe despite regulatory changes, we should be able to grow. No regulator is trying to strangle industry. They are also interested in growing our industry, and it is their steps like mutual fund Sahi Hai campaign which resulted into growth of this industry. So I have no reason to believe that regulators will not allow this industry to grow. In fact, I am a firm believer that it is because of regulators' support that this industry is growing.
Sure. One final comment, Nilesh. If you could just articulate what is it that makes you bullish on the India story, that is the economic growth story, and what makes you bullish on the Indian market side? What is it? I mean, are the two the same? Are they different?
So I think why we are bullish on India is because of Indian entrepreneurs. We have tremendous entrepreneurs who have created growth story in India despite all the challenges. Look at IT sector, look at generic pharma, look at engineering sector. Time and again, you hear stories of Indian entrepreneurs. Despite all adversities, they have created value. What makes us bullish on India story overall is 3G. One, our earnings growth will be better than our peers. Two, our governance standards will be better than our peers. And third, the green transformation. Our economy will lead green transformation. As long as India delivers on this 3G of growth, governance, and green, my feeling is that investors will not be disappointed.
Sure. Thank you so much, Nilesh. It was a pleasure talking to you as usual.
Thank you, Mahalakshmi.